The 2025 housing crash is no longer a distant prediction whispered by analysts. It is unfolding in front of us, city by city, neighborhood by neighborhood, with numbers that look hauntingly similar to the darkest months of 2008. But this collapse is more complex than a simple decline in home values. It is the story of entire local economies starting to crack under the pressure of rising insurance costs, structural weaknesses, climate risk, migration reversals, investor speculation, and a decade of unrealistic expectations that could not survive contact with economic reality. What makes this downturn so striking is how many Americans still believe it is a temporary dip, a pause before another boom. They are clinging to the idea that the market will rebound simply because it always has. But the fundamentals today are not the fundamentals of 10 or 20 years ago. We are dealing with new variables, costs nobody prepared for, shifts nobody predicted, and risks nobody took seriously until it was too late. Today on Discover the Nation, we're examining 10 cities where home values aren't dipping. They're collapsing, in some cases by half or more. Markets that were celebrated as the next big thing are now cautionary tales. Families who thought they bought into the American dream are discovering that dream can be repossessed as quickly as it was sold to them. Stay with us, and before we begin, tap that like button and subscribe to Discover the Nation. The information we're about to cover may keep you from making a devastating financial mistake. Let's begin our countdown. Number 10, Cape Coral, Florida. At first glance, Cape Coral feels like a Florida paradise brochure made real. Miles of canals, endless sunshine, waterfront homes, a tax structure designed to attract retirees and remote workers. It looks like a calm, prosperous dream until you check the data. In less than 24 months, the median home price dropped from roughly $465,000 to around $260,000, a slide of more than 40%. And the decline continues. But the collapse here is not driven solely by home values. Insurance is the real wrecking ball. Florida's insurance market is under historic strain. Premiums that once cost $3,000 a year now routinely jump to $8,000 to $10,000 on modest homes. Many insurers are withdrawing from coastal regions altogether. Homeowners who were once comfortably insured are suddenly dropped with 30 days' notice. One couple watched their insurance double while the appraised value of their home fell over $100,000 below what they paid. Their housing asset became a liability nearly overnight. Hurricane Ian's aftermath is still visible in unfinished repairs, elevated construction costs, and neighborhoods dotted with half-completed renovations. Some HOAs issued special assessments that hit families already struggling with insurance inflation. Listings sit on the market for half a year or longer. Price cuts aren't mild. They're desperate. One waterfront property listed near $899,000 sold for barely over $400,000 and only after months of silence. Cape Coral is now a case study in what happens when climate risk, insurance volatility, and inflated pricing collide. What's happening here will eventually echo through every vulnerable coastal market in America. Number 9, Austin, Texas. Austin was once the darling of U.S. real estate, a booming tech hub, a magnet for remote workers, a cultural hotspot with seemingly endless momentum. For a while, the hype delivered. From 2020 to 2022, home values surged nearly 90%, but the boom disguised deep structural weaknesses. Tech companies expanding too fast, investors overpaying, remote workers flooding in without anchoring long-term roots. By mid-2025, the median home price plunged from $575,000 to roughly $385,000, a one-third drop with more softness expected. High-rise apartments now offer steep concessions just to stay occupied. New construction homes sit untouched for months. Condos bought at peak pricing have lost value so rapidly that some owners are underwater on their loans. Austin's problems run deeper than prices. Layoffs in tech weakened demand, 7% plus mortgage rates crushed affordability. Power grid concerns made buyers cautious. Insurance costs and extreme heat added financial pressure. Migration inflows slowed, then partially reversed. The city that was supposed to be the next Silicon Valley now faces the reality of a market that grew faster than its economic foundation could support. Number 8, Boise, Idaho. Boise was once the Mountain West's most promising star, quiet, scenic, affordable, and loved by anyone tired of big city stress. Then remote workers arrived with big paychecks and bigger expectations. Between 2020 and 2022, home values jumped over 70%. Then came the reversal. By 2025, prices have fallen nearly 50%, wiping out years of artificial gains. The core issue, prices soared far beyond what local incomes could support. Remote workers bought aggressively, then left once tech flexibility tightened. Boise was left with inflated valuations and far fewer buyers capable of supporting them. Entire subdivisions built for newcomers now stand half-occupied. Investors who plan to flip for profit are selling at six-figure losses. Rents fell as vacancies rose, tightening cash flow for landlords who bought with optimistic spreadsheets but little margin for error. Wildfire risk, rising insurance costs, and climate uncertainty add more pressure to households already stretched thin. Boise became a boomtown built on temporary demand, and temporary demand always disappears. Number 7. Las Vegas, Nevada. Las Vegas is no stranger to volatility, but the 2025 downturn has exposed vulnerabilities even veterans of the 2008 crash didn't expect. Home values that soared to roughly $475,000 during the boom have fallen into the high 200,000s, a decline pushing close to 60% in some segments. What triggered the fall? During the pandemic surge, short-term rentals exploded. Investors snapped up homes expecting endless tourism, but competition increased, visitor spending softened, and many owners discovered their business model no longer worked. Occupancy dropped. Nightly rates fell, maintenance and HOA fees rose. Insurance premiums jumped due to heat and environmental stress. Meanwhile, water scarcity and record-breaking summer temperatures raised legitimate questions about long-term sustainability. Las Vegas is resilient, but the current housing reset is brutally revealing. Markets built on speculation always come down harder than markets built on fundamentals. Number 6. Phoenix, Arizona. Phoenix may be one of the clearest symbols of 2025's housing crisis. At its pandemic peak, the median home price hit the low 600,000s. Today, many areas hover in the low 300,000s, a drop near 50%. Phoenix's problems are multi-layered. Investor speculation created artificial demand. Remote work increased migration beyond sustainable levels. Massive construction created oversupply. Rising rates killed affordability. Triple-digit heat sent utilities skyrocketing. Water supply concerns spooked buyers. Insurance companies began tightening policies or raising premiums. Homes sit on the market for 5 months or longer. Sellers increasingly offer closing credits, rate buydowns, and steep reductions just to attract interest. Phoenix, marketed as an affordable alternative to California, now struggles under the weight of its own growth optimism. Number 5. San Francisco, California. For years, San Francisco was considered virtually bubble-proof. Tech wealth protected it. International demand validated it. Ultra-limited supply was thought to guarantee endless appreciation. But no city is immune to structural change. From a median of $1.6 million, home values have dropped to under $900,000 in many neighborhoods, a stunning reset of more than 50%. Remote work hollowed out the city's core. Office towers sit half empty. Retail corridors are quieter. Residents question whether paying a premium makes sense in a hybrid work world. HOA fees remain high, maintenance costs climb, and insurance grows more unpredictable due to wildfire exposure. Many owners face a painful choice: hold on to an expensive depreciating asset or sell at a steep loss. San Francisco's correction reflects a painful truth. When the jobs move, the people move. When the people move, the prices follow. Number 4. Myrtle Beach, South Carolina. Myrtle Beach was once a cash flow paradise for investors. Sun, sand, and short-term rentals made it America's beach town jackpot. Then oversupply, rising costs, and tourism shifts broke the model. Home values have fallen more than 45% since 2023. HOA fees ballooned. Insurance rates rose sharply. Occupancy dropped. Maintenance backlogs grew. Aging buildings demanded expensive repairs and special assessments. Investors who purchased multiple properties now face negative cash flow. Locals struggle with rising costs that tourism no longer offsets. New developments create oversupply in a market already saturated. Myrtle Beach proves that coastal investing is not a guaranteed win. It's a balancing act between risk and reward, and right now, the risk is winning. Number 3, Salt Lake City, Utah. Salt Lake City was once presented as the perfect compromise. Mountain views, clean streets, a growing tech sector, and cheaper real estate than California. The boom was fierce. Values surged 75%. The correction is equally fierce. Values have fallen 40%. The remote worker wave that inflated prices disappeared when companies tightened hybrid schedules. Builders overproduced, investors chased quick gains. Now homes sit for months with shrinking demand. Wildfire risk, stricter insurance guidelines, and earthquake concerns add complexity. Meanwhile, rents softened as vacancies rose, hitting landlords and small investors hard. Salt Lake City became another example of a market priced for growth that never materialized. Number 2, Naples, Florida. Naples represents luxury Florida living. Gated communities, golf courses, waterfront estates, and high-end amenities. At the peak, some neighborhoods averaged $1.1 million. Today, many of those same homes sell for half. Hurricanes reshaped the insurance landscape. Premiums that once cost a few thousand now reach 5 figures. Citizens, the state's last resort insurer, is overwhelmed. HOAs in Naples are notoriously strict and expensive. Special assessments for seawall repairs, roof replacements, and infrastructure improvements can reach tens of thousands. For many retirees living on fixed incomes, the new financial reality is impossible to maintain. Naples was built for luxury, but luxury now comes with a cost few can justify. Number 1, Palm Springs, California. Palm Springs is the epicenter of the 2025 correction. Home values soared to nearly $1.2 million during the pandemic. By 2025, the median is in the high 500,000s, a brutal 50% supply decline. The collapse in short-term rentals struck hardest. Airbnb-style investment flooded the area, but new regulations, permit restrictions, and declining tourism crushed occupancy rates. Wildfire risk caused insurers to pull out. Utility costs skyrocketed in desert heat. Water restrictions became more aggressive. Maintenance for vacation rentals grew expensive and unpredictable. Palm Springs still photographs beautifully, but the economics behind those photos have changed dramatically. It is now the clearest example of what happens when hype, climate risk, regulation, and speculative money collide. From Cape Coral to Palm Springs, the message is clear. The 2025 housing downturn is not a cycle. It is a recalibration. Real estate markets built on hype, climate denial, and unrealistic migration forecasts are now facing reality. If you're considering buying in one of these markets, you need to evaluate more than price. Look at insurance, climate risk, long-term job stability, HOA finances, infrastructure strain, and whether the local population can actually afford the homes being built for them. If you already own in one of these cities, you know what the headlines don't say. The crash is not theoretical, it is lived experience. If this investigation helped you understand the broader picture behind the numbers,